Hey there, folks. Greg Shepard here, S&A Financial Services. I specialize in helping folks just like yourself in higher education get the most out of that oftentimes confusing higher ed retirement plan, typically around TIAA accounts. So I've told you in the past, when I run across a situation, scenario that I think would be advantageous to the masses out there, I will share it with you. This is such a case. So let me set the stage here. Excuse me. So before I get going, this strategy that I'm about to talk about is only really applicable for those that are, I shouldn't say only, but the reason this is applicable for this situation, and probably maybe for yours as well, is that if you have a married couple where the ages are a little wider, okay? In this case, we had a male participant, female spouse, female I think it was 9 years younger than male participant. Very important in this scenario. Okay, backdrop. 700,000. Looking at retirement next year, early next year. $700,000 in TIAA Traditional in an illiquid contract, unbeknownst to the participant, which was a great surprise. I say that sarcastically. A great surprise to him. He never really figured that out until it's not too late, but up until the end, close to retirement. So freaked out a little bit. That might be a little dramatic, but nonetheless worried as to how they are going to extract these monies. Okay, two important things that they wanted to focus on: liquidity, estate planning. Okay, because they have a lot of assets, right? The liquidity issue was a little bit of a problem because, as he thought, he could only take a lifetime income annuity option. So what I did, I kind of knew the answer before we got going. So I sat them down, did a Zoom call, did that whole thing, and we started off with the lifetime income annuity option. Okay, what we all found, is that the lifetime income annuity option payments, they were fine. Okay, that it was somewhat attractive. No inflation guarantee protection going forward. That's a little bit of an issue. Estate planning component was pretty much non-existent because upon his death, they wanted to opt for the 50% to her, okay? And then once she's gone, that money gone, okay? Their two children wouldn't be a benefactor of that lifetime income annuity option, which is a little tangent here. Often a surprise when I talk to children of participants thinking they're going to inherit X amount of dollars from TIAA. Once both parents pass away, they get goose egg and they wonder why. That is why, okay? Well, I don't want to open a can of worms there, but the estate planning component for this particular situation was not very good or non-existent at all for the children. Okay, so what we did is, because of that 9-year discrepancy in age, I wanted to show them what it would look like if, doesn't really matter, it's irrelevant, if the spouse were 5 years, 4 years younger than the participant. And that lifetime income annuity option all of a sudden became a lot more attractive. Okay, common sense. We're using actuarial formulas. Okay, so the younger you are, obviously, the longer years you have that TIAA in this case is going to pay you theoretically. Okay, so 9 years being the age difference, the lifetime income annuity option really wasn't very attractive. Comparatively speaking, there's my email. Sorry about that. 10-year TPA was afforded to them, okay? This all of a sudden became more attractive to them because it's a 10-year TPA paid out over 9 years, though those annual payments, of course, were a lot more than what they could get in the lifetime income annuity option, because the lifetime income annuity option, as the name implies, is paid over a lifetime. This is only 9 years. We direct those payments to a rollover IRA. Now they have more monies, okay, that we commingle. They extract from that rollover IRA for income as needed. Are you catching me here? So the reason this 10-year TPA was more attractive for this situation, it's 100% due in this case because of that age discrepancy. If she were 4 or 5 years younger, or same age, of course, that lifetime income annuity option would have been a lot more attractive to them, sacrificing that liquidity part of their need. Okay, they were okay with that. They would have been okay with that. But also the estate planning part of it, when you roll those monies over to an IRA, in this case that TPA to a rollover IRA, assuming he dies first, which is normal in this situation, she would inherit those monies. But upon her death, they can't even try to spend all these monies. They can't spend all these monies even if they tried, which I probably could. But the children are going to get whatever's left over, okay, split between the two of them, right? So it's a better estate planning tool for this purpose as well. Hopefully this made sense. This is not investment advice. I just want to make sure I emphasize the fact that A, make sure you know your TIAA traditional rules out there, the restrictions therein on how to extract the monies. That's number one. Number two, if you have an age discrepancy between you and your spouse, whomever that beneficiary is, okay, typically spouse, let's start looking at other options, okay? It might be more advantageous, like I said in this case, that 10-year TPA suited their situation better. All right, folks, hopefully that made sense. Greg Shepard here, S&A Financial Services. Hey, you all go and have a good one. All right, take care. Bye-bye.